So I'd like to welcome Helen Hayes, Managing Director of iShares Canada for BlackRock, where she is responsible for strengthening iShares leadership position in Canada and deepening client relationships. Prior to joining BlackRock, Helen spent most of her 25-plus-year career in capital markets, including at UBS and CIBC. I've had the pleasure of sitting down with Helen before and talking markets and talking everything business. So this, for me, is a lot of fun, brings back memories, Helen. So welcome to the show.
Yeah, thank you so much, Alan. It's great to be here. I'm really looking forward to the conversation today.
Excellent, excellent. I thought, as I always like to do, kind of more of an informal conversation, kind of a chat as to what you're seeing there at BlackRock. In this new era of high volatility, high inflation, and unfortunately uncertainty, what is BlackRock's ETF outlook for the remainder of the year? What are you seeing there at BlackRock?
Yeah, Alan, I think the markets certainly have been difficult this year, and at BlackRock, historically, we refer to the Great Moderation, which was a period of low inflation and stable economic growth that began in the 1980s. And certainly, I think you'd agree, it's come to an end. And the new regime is a result of pandemic-related implications, unfortunate geopolitical conflict, and global supply chain issues. And all of these things have had impacts to the markets, and as a result, to people's portfolios. And when it comes to implications of sustained volatility, we really view at BlackRock our long-term view remains our North Star of staying invested. And I think you're very much aligned with that, Alan, in terms of how you manage portfolios. And certainly in this environment, I think what we've seen is increased demand for more sustained and I think nimble ways to invest in today's uncertain market. And what we've really seen in periods of high volatility is ETFs have been a really essential part of access to the markets and are key in this transition. So earlier this year, this fall, we put out an updated investment guide. And we identified three key investment themes that I think still stay strong as we head into the end of the year. Number one is embracing volatility. Number two is living with sustained inflation. And number three is the long-term impacts of shortages and how we think about that from a market perspective. And, we look around the world as central bankers try to navigate and balance, this soaring inflation and slowing growth. And I think we've seen risk premiums are certainly on the rise. And so defensive positions have made the most sense, both to minimize drawdowns, and for us, that's a little bit of the new alpha. In equities, we have seen a lot of inflows into minimum volatility strategies in terms of portfolio construction. And that really reduces, Alan, overall portfolio risk and allows the end investor to hedge against potential significant drawdowns this year. Dividend ETFs, certainly no surprise, obviously have been a source for people looking within their portfolio construction in terms of finding that stable income, value, and quality in a portfolio. So certainly from our perspective, whether it's from a U.S. stance or iShares Core MSCI Quality Dividend Index XDU or our MSCI Global Quality Index ETF, have all certainly been in favor. And I think, when we think about living with sustained inflation tips, that's certainly been an area when we look at the structural factors right now in the market. And, everybody keeps wondering whether inflation will disappear all of a sudden. And I think, I don't know what your view is, Alan, but I think it'll stay higher for longer. So I think that argues certainly for inflation-linked bonds over conventional bonds. And our iShares 0 to 5 year tips index ETF, we've got one that's Canadian hedged, STH, has certainly been one where we've seen a lot of inflows. I also think that from a sector perspective at BlackRock, healthcare is another area where we think when you think about sustained inflation and you think about pricing power within the healthcare sector, that's one that we really like as well. And certainly iShares Global Healthcare Index ETF, there's a Canadian hedge version as well. We've seen a lot of inflows there. And I think lastly, long-term impacts of shortages. So, you can't open a paper and not see headlines, whether it's energy or commodity-induced volatility. Going to the gas station, it's costing people way more to fill up their cars. And then obviously food inflation. You go to the grocery store and you're walking in and getting sticker shock from something that's 20% higher than it was the last time you were there. And that might be an exaggeration, but I think, it doesn't take much to see and really feel, Alan, what's happening in the economy at the moment. And certainly from an agricultural perspective, we've seen excellent flows into global ag ETFs, and for us here in Canada, the iShares Global Agricultural Index ETF, or COW, as it's referred to, has also had a lot of inflows. As people have looked within portfolio construction alongside their single stocks, how do we play these different themes?
Yeah, no, that's a great breakdown of what you're seeing. I guess in general, a lot of questions have come to me recently about asset allocation.
Right.
In terms of money flow, do you find that more money has been flowing into some of the more fixed income ETFs or more of the equity ETFs in general? Do you find people are being a lot more conservative over the last 6 to 8 months, or do you still see people trying to take advantage, buy the dips, if you will, in some of these with some of these ETFs?
Yeah, it's super interesting what we've seen this year. And in periods of high volatility, we do see investors turn to ETFs, especially fixed income, which I'll get into. This was an interesting stat that I saw from an update that we had from BlackRock, which was net inflows to ETFs surged to over 110 billion globally in the month of October. And when I look at the quarterly flows here in Canada, ETFs once again outsold mutual funds this quarter. And as of the end of September, Alan, Canadian ETFs gathered inflows of about 25 billion. And, again, we've seen people move to this more defensive stance, whether, as we mentioned already, it's dividend or minimum volatility ETFs. We've also seen that flow into fixed income as well as high yield savings and cash related ETFs, that people have been looking for that yield. And it's interesting, fixed income. So when the pandemic hit, again, I think that is when we really saw the beginnings of whether it's an end retail or an advisor or an institutional client start to think about using fixed income ETFs because they performed so well in the high volatility market at the beginning of the pandemic. And so what's been interesting is with rising rates, Alan, and the environment of slowing growth and inflation, globally at BlackRock, across our iShares, 50% of our global iShares year-to-date flows have come into fixed income ETFs. It's a huge stat. And in Canada, across the ETF industry, fixed income ETFs year-to-date, the last stat I had was about 6 billion in inflows this year. When you break down where people are going, Alan, I think it's a really important point for us to focus on. It's short-dated maturities. So really the front end of the curve, as people are looking to take advantage of bonds that are trading at a discount to par, but again, are on the short end of the curve. So, we have a partnership with RBC. It's RBC iShares. And what's been interesting is to watch between our two product offerings. We've seen strong inflows, over 100 million, or almost actually 150 million in Q3 into RBC's Canadian discount bond ETF, which is RCDB as an example. On the corporate bond side, it's also been quite popular really over the last quarter. So our iShares Core Canadian Bond Index ETF, XCB, and then RBC's Target Maturity Corporate Bond Family. All in all, we have seen almost 400 million of inflows, and that's over the last quarter. So, it's been so interesting how significant it is.
Yeah. I was going to say, yeah, and I guess obviously higher interest rates and the talk, all you hear about on the business channels and all the business folk talk about how you can get into these short-term bonds yielding, 4 or 5%,
yep,
when these products were yielding 1-2 at the start of the year. So I guess in your opinion, with a lot of recession fear, talk of recession maybe as early as first quarter next year, would you say this is how individual investors are managing risk by going into these products?
Yeah, I think it's a combination. I mentioned earlier when we talk about these cash-like exposures, right? And certainly we have seen huge inflows into cash-like ETFs. We've seen big inflows into dividend ETFs, which, as you mentioned, with dividend yields of about 4.5%. We've also seen big inflows into energy and ag. Our XEG, which is our iShares S&P capped energy index ETF, is up almost 60% year to date. So again, people have positioned themselves from an asset allocation model in fixed income, in equities, but in specific areas. Or they've looked to a cash-related ETF from a standpoint of looking for yield that really correlates with where interest rates are moving to. So it's been really interesting to see.
Yeah, for sure. And I guess lastly, for a lot of investors, the term ETF is something that is fairly new to many people. 10, 20 years ago, ETFs were definitely not as prominent as we're seeing today in portfolios. So I guess in closing, what would you say, or how are ETFs playing a role in portfolio construction today? Where are you seeing them being used most at this time?
Yeah, so I think, there's a couple of things to mention on this. And what's interesting about an ETF, it's similar to a mutual fund, but it trades every day. So if you can combine your portfolio construction, Alan, from a single stock perspective, and then you can, in as little as one ETF ticker, investors can build broadly diversified portfolios. So what's interesting about it when we talk about asset allocation and you're making those decisions, when you're building your whole portfolio, ETFs have been shown to deliver that competitive performance, the low cost and transparency. So it makes it easy, efficient, and I think, very accessible. So if you decide, Alan, you want to have a broad exposure like an S&P 500, or you want to have commodity-related exposure, there's ETFs really to solve for that within your portfolio, where you have your single stocks, but at the same time, you want to own a basket of stocks within one ETF. And so they really become an essential building block of investment portfolios, and you benefit from a targeted exposure, lower cost diversification, that liquidity, and that transparency. And I think, again, that is why we have seen ETF adoption, certainly over the last 3 years, really increase. And, we talked about cash ETFs. If I can spend another moment on that, Alan. Cash ETFs have now seen year-to-date $5 billion in inflows. The month of September alone, Alan, cash ETFs had inflows of $1.8 billion, the highest monthly inflow ever. And certainly at iShares, we've seen this show up through our iShares Premium Money Market CMR or our iShares Floating Rate Note ETF XFR. And it's just been amazing. So between fixed income and cash, just the amount. And it's not that people are building entire portfolios. I think within how you think of the world, Alan, it's single stock plus saying, I'd like to get exposure here. And I can, whether it's, again, fixed income, or whether it's looking at S&P TSX or composite or megatrends, saying I want to be in global infrastructure ETF or I want to be in global clean energy ETF. You can have all of these from a standpoint of your portfolio construction, which I think it really plays an accessible way for investors within their portfolio construction.
Yeah, it's unbelievable. Those numbers are staggering, and that's why BlackRock is the biggest. Helen Hayes, Managing Director and Head of iShares Canada, thank you so much for being on the show today. It was great to see you again.
Yeah,
and I look forward to seeing you again soon.
Yeah, thank you very much, Alan. Take care.
Thank you. Take care.